Most small businesses don't die because of poor ideas. They die because their cash runs out. You can have great sales, loyal customers, and strong products, and still struggle to pay bills on time. That's the hidden danger of cash flow problems. In this video, you will learn how to fix your cash flow problems with practical examples. Problem number 1, late payments from clients. Late payments crush liquidity. If a project invoice of $10,000 is delayed by 60 days, your bills still need to be paid today. Fix this by offering 2% discount for payments within 10 days, charging late fees after 30 days, and switching to milestone billing. For example, bill 50% upfront, 30% midway, and 20% at delivery. This keeps steady cash instead of waiting months for a single check. Problem number 2, high accounts receivable aging. If your accounts receivable are stuck at 90 days, it means you are financing your clients. If you have $60,000 stuck for 3 months, that's money not fueling marketing, payroll, or inventory. Fix this by enforcing net 15 or net 30 payment terms, sending automated reminders at 7, 14, and 21 days, and requiring credit checks before extending large terms. The goal is to reduce aging from 90 days to 30 days. Problem number 3, seasonal sales fluctuations. If winter months bring in $40,000 and summer months bring in $100,000, you need a buffer strategy. Fixed expenses like payroll, rent, and software subscriptions remain constant. Fix this by building a cash buffer equal to 2 months of fixed expenses and introducing off-season offers, maintenance packages, or prepaid discounts. Predictable monthly revenue protects survival during slow periods. Problem number 4, low profit margins. If you sell something for $100 but your gross margin is only $20, your cash flow will always feel tight. To fix low margins, increase prices strategically, cut cost of goods sold by renegotiating with suppliers, or remove low-profit items. Even increasing margin from $20 to $30 per unit changes survival math over 1,000 units. That's a $10,000 difference in available cash. Problem number 5, high operating expenses. If your revenue is $50,000 monthly, but your operating expenses are $40,000, you only keep $10,000 for growth. Reduce recurring expenses quarter by quarter. Audit software tools, renegotiate leases, review utilities, and remove non-essential subscriptions. A 10% cut in expenses on $40,000 saves $4,000 monthly or $48,000 yearly in cash retention. Problem number 6, uncontrolled spending. A business earning $90,000 but spending $85,000 feels poorer than one earning $50,000 but spending $30,000. Track spending weekly instead of monthly. Use envelopes for ad budgets, set department caps, and require pre-approval for anything above $500. Spending discipline is the fastest cash flow fix, even if revenue stays flat. Problem number 7, overstocking inventory. Buying too much inventory ties up cash. If you buy $70,000 in stock but sell only $30,000 in 90 days, $40,000 of cash is sitting on shelves. Switch to just-in-time ordering, forecast demand based on 3-month historical averages, and stop emotional buying. Every dollar of inventory is a dollar not available to pay salaries. Problem number 8, underpricing products or services. If you charge $80 for something competitors charge $120 for, you are leaving $40 per sale on the table. Pricing too low forces higher volume to survive, which strains operations. Increase pricing by 10 to 15% first. Most customers don't leave. That extra 10% on a $500,000 yearly revenue equals $50,000 extra cash without selling one extra unit. Problem number 9, weak invoicing and billing systems. If invoices go out late, cash comes in late. When businesses invoice on the 15th instead of the 1st, they lose 14 days of cash timing. Automate invoicing on the first day of every month. Enable ACH payments and remove manual PDF invoicing. Faster billing equals faster cash. Companies that invoice digitally get paid up to 40% quicker. Problem number 10. Too much customer credit. Giving every customer net 60 terms means you are bankrolling their business. If you have $100,000 stuck in credit terms, that's cash you can't use. Fix this by offering credit only to high-trust clients, requiring deposits, and turning small clients into prepaid customers. The best businesses in America get paid before delivery or at least 50% upfront. Problem number 11. Short supplier payment terms. If you have to pay suppliers in 30 days but customers pay in 60 days, you will always suffer a cash gap. Ask suppliers for net 45 or net 60, or offer early payment only if discounts are given. Extending terms by 15 days on $50,000 of monthly purchases frees up $25,000 in working capital every 30 days. Problem number 12. High loan payments and interest costs. If your monthly loan payments are $20,000 on a cash flow of $60,000, your margin for error is tiny. Fix this by refinancing high-interest loans, negotiating longer amortization periods, or accelerating payoff on small debts first. Even reducing interest by 2% on a $500,000 loan saves $10,000 yearly in cash. Problem number 13. No emergency cash reserves. When unexpected expenses hit, like a broken machine costing $8,000 or a tax bill of $15,000, businesses without reserves panic. Build an emergency fund equal to 1 month of operating expenses, then grow it to 3 months. If your operating expenses are $40,000 monthly, aim for $40,000 to $120,000 reserved in a high-yield account. Emergency reserves also build confidence. When a surprise repair or tax bill hits, you pay without panic, without loans, and without slowing operations. This safety cushion is what separates stable businesses from fragile ones. Tracking daily business expenses keeps your cash flow healthy and predictable. This video shows simple ways to record spending, avoid leaks, and keep money under control so you never run short again. Strong cash flow starts with small daily habits. If you found these tips useful, like the video, subscribe, and start tracking your expenses today. Your business will thank you when money gets tight.